Is the economy at an inflection point? The Consumer Sentiment Index is published by the University of Michigan is at an all-time historical low. Inflation is ticking up. The U.S. naval blockade of the Strait of Hormuz is amplifying the already tense situation in the Middle East, and oil prices, the WTI remains around $100 a barrel. What is next for the finances of the Treasury? Is the government insolvent at this point? We'll find out all this and much more with Professor Hanke, Steve Hanke, Professor of Applied Economics at Johns Hopkins University. Good to see you again. As always, Professor Hanke,
Yeah.
Welcome back.
Thank you. Good to see you, David.
I understand you just had a successful surgery on your hand. It's good to,
I
it's good
did.
to have you.
I
It's
did.
good to,
It was successful. That's why I'm absent my necktie. I can't tie it
Well,
with one hand.
well, we're glad that you're in good health and your surgery went well. That's most important, and you look great. This is the first time in my entire career I haven't seen you in a tie, so this is a nice surprise, nice little switch up. Now, I want to talk about the White House budget director. By the way, he testified he cannot estimate the cost of the Iran war. A Harvard projection is estimating it a cost upwards of $1 trillion. We're going to get into that projection in just a minute, but I want to bring something up to your attention. This is an article you wrote in Fortune magazine a couple weeks ago, last month in March. The Treasury just declared the U.S. insolvent. We have talked about this in more detail last time, link down below for the last episode. But apparently it's been fact-checked. You've been fact-checked, Professor. According to factcheck.org, the U.S. Treasury didn't declare the country insolvent. I mean, that's not really what you said. You just said they are looking like they're going to be insolvent. They declared it, I guess, figuratively speaking, not literally. But anyway, the fact checkers at factcheck.org took it upon themselves to write two economists, Steve Hanke at Johns Hopkins University and David Walker, a former comptroller general of the U.S., published an opinion piece in Fortune last month advocating bills aimed at reining in the national debt, rather. The headline on the March 23rd piece, the Treasury just declared the U.S. insolvent. The media missed it, became a viral claim on social media. That is true. But there hasn't been a declaration. One reader asked us about a post that suggested Donald Trump was to blame. The U.S. Treasury did not declare the U.S. government insolvent, said Ken Smetters, faculty director of the Penn Wharton budget model, who told us that he agreed with the larger point of the opinion piece, that the government's fiscal policy is imbalanced and in need of changes. But the writer cited the most recent annual report from the Treasury released in March that listed the government's total assets for the fiscal year. From that, they concluded the U.S. government is insolvent. That's not hyperbole. It's a conclusion drawn directly from the Treasury Department's own consolidated financial statements for fiscal year 2025. And it goes on to basically argue that this is an overstretch, bit of a stretch here. Okay, so you've been fact-checked, Professor. How would you respond to this?
Well, the fact checkers are simply displaying their ignorance and stupidity more than anything else. The Treasury did declare insolvency because they produced financial statements, and the former comptroller of the United States, Dave Walker, and I analyzed those. There are a huge volume of these financial statements that come out every year, mandated by law, and the assets of the U.S. government come in at $6.1 trillion, and the liabilities are $136.2 trillion. By definition, you're insolvent.
So here it says, look, the experts they spoke with broadly agreed with the claims that you're making. The last sentence of this paragraph sum it up, and I'll let you take it from here. But the Treasury has not revealed any new insolvency. The government's liabilities have been larger than its assets in the Treasury's annual reports going back decades. Okay,
that's true. That's true. It isn't anything new. The government's insolvent. It's a fact that the thing with the fact checkers, clearly they can't read financial statements. I must say, to read these correctly requires a great deal of skill. Unfortunately, my colleague Dave Walker, or actually David M. Walker, as he signs our article, was the comptroller of the United States and knows the shall we say, nature of these kinds of government accounting documents, which are pretty hairy to go through. But once you get down to the bottom line, it's always assets and liabilities. And if the liabilities are many times greater than the assets, you know unambiguously you're insolvent. I mean, anyone watching this program must be getting a laugh out of the fact checkers. It really, in general, by the way, is just getting off of the fact checking of this particular thing. The fact checkers, most of this stuff should just be put in the rubbish. You get some undergraduate who'd been at some third-rate college majoring in sociology or something like that, and they're doing the fact checking. I mean, they can't read a financial statement.
All right, I think the premise of the article.
Of course, that's why they're not on Wall Street, and they're in an organization called factcheck.org.
I think they misunderstood the premise of your article, which is that I don't think the Treasury literally declared bankruptcy. It's just that they have been insolvent. Anyway, let's move on. Yes.
I disagree with that. The press release headline didn't say that they declared insolvency. The financial statements make it unambiguously clear that they are insolvent. They don't have to announce it; they are, by the law, they're required to produce the financial statement. By the way, and they do that every year.
Okay, well, before we move on, then, what happens when the government is insolvent? I mean, it's not like a business where an individual, we file Chapter 11 and we move on, and our credit takes a hit. But the government's a bit different.
No, the government's indifferent because there's one big difference. They can run the printing press and produce money. So technically, many developing countries do go insolvent and do not pay off their debts. The United States does not. It's a great power. It does have the printing press, and ultimately could print its way out of a wet paper bag if it had to, and not declare bankruptcy, and they would continue to pay their obligations, of course, in devalued dollars. That's what would result from the thing. But at any rate, the statements are what the statements are, and things will keep plunking along as they have been over the years. However, as the Congressional Budget Office, a bipartisan organization, indicates, things are deteriorating very badly. We've got fiscal folly that's taking place in Washington, D.C., particularly the last three administrations. You got Trump 1, and then you got Biden, and then you've got Trump 2. And both of those, I should say, all three of those administrations have engaged in fiscal folly, running huge deficits, huge increases in government expenditures. And ultimately, those deficits, David, the main point is those are just deferred taxes. Those will be paid by future generations. And they'll either be paid by increasing the taxes paid on April 15th, tax day, or they'll be paid with an inflation tax, one of the two.
Before we continue with the video, let's talk about a topic that's been on a lot of precious metals investors' minds: how to generate income with your gold holdings. Most assets either generate income or rely on price appreciation. Gold has traditionally fallen into the second category. Our sponsor today, Monetary Metals, has found a way that lets gold do both. Instead of just holding gold and waiting for price moves, investors can now earn a yield on it paid in physical gold. Through the leasing platform, investors can earn up to 4% annually with yield paid monthly in ounces. That means your holdings increase in gold over time. The metal remains in your asset base and can be redeemed at any time. Thousands of investors are already earning monthly interest in gold through Monetary Metals, so visit monetary-metals.com/Lynn in the link down below, or scan the QR code here on the screen and make the most out of your gold today. Or the government can just spend less, and none of that will happen.
Right. I mean, there are, But I'm saying, looking at the projections,
Right.
if you look at the projections by the Congressional Budget Office, their deficits is clear as far as the eye can see.
Yes.
And all the forecasts, you can argue, well, maybe you want another forecaster, but they're all saying more or less the same thing. And by the way, at the margin anyway, the congressional budget has turned out to be more accurate than almost all the forecasters, except they're about the same as the so-called group of professional forecasters. But any way you cut it, the scenario is one of deficit, and increasing debt to GDP ratios, and increasing the size of government relative to the private sector. All of those things come through, and that's why Walker and I are the former comptroller of the United States government, and I are for amending the U.S. Constitution and putting some kind of debt brake in the Constitution so that things operate as they originally did, as the founders intended, but never wrote it into the Constitution. But the practice was to follow Adam Smith and the Wealth of Nations, 1776. By the way, the same year the Declaration of Independence of the United States. And what was Smith's principle? No government spending unless there were taxes to finance it and taxes matching it. So if you want to spend, you tax an equal amount, and that's it. And you don't over the course of the business cycle, you don't run deficits.
Right. Well, this brings us to my next point, which is something I've alluded to in the introduction, which is that the Iran war is going to cost a lot of money. Now, the White House Budget Director Russell Vought said on Wednesday he could not estimate the cost of the Iran war. We're not ready to come to you with a request. We're still working on it. We're working through to figure out what's needed, Vought told the House of Representatives Budget Committee. Meanwhile, Harvard University has taken upon themselves to make the study. I'm certain we will reach $1 trillion for the Iran war, said Professor Linda Bilmes, public policy expert at the Harvard Kennedy School. I don't know, I haven't looked into the study myself, but let's take the Harvard number, $1 trillion. Functionally, what does that mean for the American taxpayer?
Well, this particular study I haven't seen. First, let's go back to the director of OMB. They're entering a war. This is how irresponsible the government is. They're entering a war and they have no idea what the cost is going to be. That's what he's saying. Now he's talking about the budget cost, the fiscal cost, and that's what we were talking about with regard to the solvency of the United States. It's going to make the U.S. more insolvent, but he doesn't know how much more insolvent. So that's what the OMB director is talking about. He's talking about the budget. I suspect that the Harvard study is more broadly gauged, talking about the wider economic consequences of the war, and not narrowly focusing only on the budget. But I don't know. I haven't looked at that study. If there are broader costs involved, the number is way greater than $1 trillion.
Let me just ask you point blank, can the U.S. afford a prolonged war with Iran?
No. I don't think they should have gone into the war in the first place, let alone... Why do you make a decision to do something and you don't know what the benefits are and what the costs are? That's the delusional aspect of the Trump administration, or any of these outfits. How about George W. Bush when he went to war in Iraq? Another big disaster. They didn't know what the benefits were. Well, there weren't any benefits. The benefits were negative to start with, and then you pile on trillions of dollars worth of cost on top of that. These things are complete disasters. How about the Vietnam War? You want to go back to the Vietnam War? How about our overthrow of Gaddafi in Libya? That was another gem.
I guess the silver lining is that, yes, go ahead.
Well, I was just going to say Libya is, of course, a classic case of regime change that failed and is very costly. And now, after all these years, they're just tangled up in a civil war, and you've got a complete state of chaos and anarchy in Libya right now. With the United States, the next thing with the United States is just announced they're going in to support the government, the so-called government in Libya, because the challengers to the government, the kind of rebels, are being supported by Russia. So there you have that. That was a great regime change. It's established a lot of stability and democracy and rule of law and all this other stuff. So it's just one disaster after the next. But the $1 trillion, I can assure you that the cost broadly measured will be much, much greater than $1 trillion.
Much more than $1 trillion? The silver lining, I guess, is the previous wars you mentioned didn't exactly bankrupt the government. I guess we can kind of draw a parallel here and say the Treasury is going to be all right. Is that fair to say?
Well, again, coming back to the insolvency thing, it will just make the government more insolvent than before, because there'll be more liabilities piled up and no assets to match them. So the gap between assets and liabilities will be greater. So we don't know what we do know one thing: they're going to have to borrow more money. Okay. Now, that borrowing of more money because of the deficits is a deferred tax, and that deferred tax will be paid at some point in the future by future taxpayers who aren't even alive today. So I would argue this is immoral. We're actually spending a lot more money than we're taxing, creating a deficit that ultimately is going to have to be paid by somebody in the future who isn't even voting on it today. They're not even alive today. So we know that future generations or young people now who are below voting age are going to have to pay for this stuff. And that's fundamentally immoral, by the way. So we've not only entered a war that many would argue is immoral in itself, but the financing of it is unambiguously immoral.
Proponents of proponents of the war would argue that it is justified because removing Iran's ability to produce nuclear weapons, and Iran, by the way, according to these proponents, is the world's largest sponsor of state-sanctioned terrorism, that makes it safer for future generations who, you're right, haven't voted for this war, but we're making it safer for our grandchildren. What do you think?
Well, I think you've just perfectly articulated the propaganda that's been coming out of Israel for 47 years. That's the line. That's the premise. The fact of the matter is they have repeatedly indicated, at least when the supreme leader, before they assassinated him, the fatwa, it was that they would not be producing these weapons. And Trump comes out repeating the Israeli line that they're within weeks of bombing the United States with an atomic bomb. The whole thing is ridiculous. On the face of it, it's not a serious argument. What you just repeated is certainly not a serious argument.
Okay, fair enough.
And if you want full articulation of that by somebody who happens to be a distinguished professor at the University of Chicago, just listen to any of the podcasts or reports by John Mersheimer, or if you really want to get into it, read his book with Stephen Walt, professor at Harvard, called The Israel Lobby. You'll get a real education to find out what realists think about what's really going on in the real world. And David, just to remind you, I
Yes.
am a realist.
Yes. You've mentioned this before. All right, I want to move on to the U.S. economy again. You've been pretty much spot on about the direction of inflation since as long as I've known you. You've been calling for inflation to come down all throughout 2022. You've been correct. You've been calling for inflation to go up ever since last fall. I think you broke the news on my show, and you've been correct. The latest headline inflation number is 3.3%. That's the highest it's been since 2024. Where is it going from here? The American people want to know.
Sean Telley, one of the senior reporters at Fortune magazine, asked me that exact question on Monday. Published a long interview with me on the topic of the March 3.3 inflation number and what caused it, and whether I was surprised. And I said no. I anticipated inflation would go up from 2.4%, and I wasn't surprised. The 2.4% was in March, but that was a year-over-year number, David. But if you looked at the 3-month annualized number for CPI in March, it was actually 3.3. It was exactly where the February year-over-year number turned out, 3.3. So I wasn't surprised. I'd been anticipating an increase, significant increase. I wasn't surprised with 3.3 for the reason I just gave you. And the reason for that was because the money supply and changes in the money supply are what eventually, with lags, cause changes in inflation. And for some time, the money supply, broadly measured by M2, has been accelerating. And that's why I said that the Fed was not going to be able to get the inflation genie back in the bottle. And to get it back in the bottle, they'd have to get it back at 2%, which is the Fed's inflation target. So a lot of commentators, by the way, also said they weren't surprised by the 3.3%, but for different reasons. And the different reason was the war in Iran has caused oil prices and prices of commodities, derivatives from oil, to spike. And they argued that's why the inflation number went up. No, it is not. That oil price spike causes a relative price of oil to go up, but it does cause the overall price index to go up. The only way the overall index can go up is if the money supply accelerates prior to whatever the date is you're reading the inflation number for. So if anyone, you can link that article by Sean Tully and people can read it. It's very straightforward, and it goes through the arguments and the arithmetic. And in particular, I go through the natural experiment we have to prove my point was in 1979 in Japan. We had an oil crisis, remember, in 1979. And what happened is that the inflation rate in 1979 actually went down from 4.1% in 77 to 3.7% in 78 in Japan because the money supply had been controlled. So, but they can read the article for the detail, but the proof of the pudding is what actually happened in Japan in 1979, because it's a very clear natural experiment that's easy to follow. Prices of oil skyrocketed in Japan, and inflation in Japan actually came down. They didn't go up when oil prices went up. Why? Because the rate of growth in the money supply from 1973, when they had the last oil price spike, actually were cut in half. That money supply growth rate was cut in half between 1973 and 1979 in Japan. So inflation is always and everywhere a monetary phenomenon. The oil price change relative prices, and many times they are correlated, highly correlated with increases in inflation. But the increases in inflation are the result of a prior increase in the money supply that just happens at the same time. That's what happened in the United States in both 1973 and 1979, by the way. And remember, in those years, we had stagflation in the 1970s. We had lower economic growth and we had higher inflation. And a lot of people said it was because of the oil price spikes in 73 and 79, but that isn't the case. It was because of the money supply acceleration prior to 73 and prior to 79.
But Professor, if you look at my screen here, this is the Fed's balance sheet, total assets from the Federal Reserve, and you can see that although the pace of change, this is percent change from a year ago, although the percent change has been increasing from negative, double digits in 2024, it was contracting. It is still contracting, although albeit at a much slower pace. So it's negative 0.5. Well, it's not yet.
Yeah, but you're getting your feet tangled up here. And we're not running you're running the David Lynch show. You're not running a fact-checking operation.
Okay.
So let me get your feet untangled.
Sure.
You're looking at the Fed's balance sheet, and the Fed is a very small contributor to the overall money supply, M2. They only contribute about 20% of the growth in the money supply. The rest is privately produced money by commercial banks. And what's happening with the commercial banks now, if you look at commercial bank credit, if you got that chart, commercial bank credit, that's growing at about 6.7% year over year right now, which, by the way, that is above Hanke's golden growth rate, a rate consistent with hitting a 2% inflation target. My golden growth rate is about 6%. So it's been accelerating for quite a while, commercial bank lending, and that's the big contributor to what's going on. That's the thing you want to keep your eye on. The Fed's balance sheet, okay, it's not irrelevant, David, but it's not a first order condition. The first order condition to look at is what's going on at the commercial banks, and they're accelerating. And what's more important, they will continue to accelerate because of two things. If you looked at bank earnings on Wednesday morning, they were huge. Bank earnings were huge. Those bank earnings contribute to bank capital, and bank capital is what gives banks the leg room, or the headroom, if you will, to make more loans, because that means they have more excess reserves. So that's one factor. The second factor is that the Trump administration and the Fed particularly are deregulating and taking off some of the regulations that are imposed on banks. And when they take those off, that frees up reserves. So you've got earnings in banks going up, that increases bank capital, that frees up reserves, and you've got deregulation of banking coming in, and people are anticipating all these things. And that means that the banks will continue to loan. As long as there are robust demands and there are bankable projects out there, they'll make loans. And when they do that and they make a loan to somebody, what happens? The credit goes into the checking account of whoever they're making a loan for, and is a liability of the banks. Of course, the loan is an asset, but the liability is the monetary liability because it's a checking deposit, and checking deposits are counted as part of M2. As part of the money supply. So all things are looking like this is going to continue. The money supply acceleration, M2, will continue, and they will not be able to contain and get the genie back in the bottle. So that's where I'm coming from on this. And it has nothing to do with the war or the price of oil, by the way. Notice I never said anything about the price of oil or the war when we've been talking about this inflation topic, because they are irrelevant. The price of oil is a relative price change. It is real. It's happened. But that simply means as the price of oil goes up and given a stable quantity of money, what happens? Well, the price of everything else tends to go down. Or not accelerate as much. as it would have accelerated if the price of oil and diesel fuel and so forth, gasoline hadn't gone up. People have less money to spend. If you have a fixed supply of money and the price of gasoline and diesel fuel goes up and people have to spend more on that, they have less money to spend on other things. So the prices of those things don't go up as fast, and the overall price index remains stable.
How concerned are you about inflation? To what extent is this going to... Yeah, let me just reframe this a different way. Let me just pull this up. The University of Michigan Consumer Sentiment Index is at an all-time low, like I talked about in the introduction. And core to the issue is the concern of inflation. So if I can just show you here the index of consumer sentiment, it is on an all-time low. This only goes back to 2016, but if you look at charts that go back even further, this is at an all-time low since the 70 years that they've been doing this survey. If you go to the homepage, you'll see a chart here that says high price concerns for personal finances. The dotted line shows year-ahead inflation expectations going down, actually, but then the red line shows a percentage of consumers citing high prices for poor personal finances going up. In other words, people are cutting back on either spending or they're citing poor personal finances due to high prices, aka high inflation. I'll get your reaction to this chart, this divergence, and to what extent people will actually cut back on spending and demand destruction being realized in the economy because of higher inflation.
Well, I am concerned about inflation, and I can say unambiguously, given the course that the money supply has been taking, the inflation genie is not going back in the bottle. So that's a general statement. Now, a more specific, the relative price thing. Everybody goes to the gas pump all the time, and they buy food. And by the way, a third of the world's fertilizer comes through the Strait of Hormuz. Well, it hasn't been coming through, and fertilizer prices are through the over 50% increase in those. So farmers aren't buying fertilizer. We're going to have food problems. Food prices will go up. That's another sticker shock. All this is funneling through into affordability. And that will be another factor that I think stupidly Trump's advisors never anticipated. They didn't see the consequences of going to war. The budget director can't even give a cost number for the budget, so they clearly didn't. They didn't see the $1 trillion kind of number, whatever that source for that Harvard study is. They didn't see anything coming. They were flying blind. I mean, Trump likes to brag about all these damn airplanes flying over and bombing everything and wiping everything out. Well, he's flying blind when it comes to finance and economics. He doesn't know what he's doing. And by the way, the testimony of the budget director proves that. The guy's clueless. He doesn't know what's going on. They can't even give an estimate of a budget number. And that's very narrowly focused. That all the costs we're talking about, the gas pump, the food prices, all these affordability things, that isn't the kind of thing the budget director was talking about that he couldn't calculate. He was talking about sharp pencil numbers that go into the annual financials of the U.S. government that are required to be filed every year, that the former comptroller of the General of the United States, Dave Walker, and myself wrote about in Fortune magazine, coming back to that thing. So I think what's going to happen, the inflation expectation on that chart, by the way, is coming down. I think that's a false signal. That'll start going up. There'll be a convergence of those two things, David. Now there's a gap. So I'm very concerned about this. And the idea, just to get some context on this thing in the war, we have this barricade now. They've barricaded the Strait of Hormuz. And so now they actually are aggravating all this affordability problem. Trump is actually making the thing worse. And by the way, it's not hurting the Iranians. The claim is that this is hurting the revenue flow coming into the Iranians. Well, the Iranians have 180 million barrels of oil that is in transit, that's beyond the Strait of Hormuz, that will be, most of it, 90%, will be supplied to China. China takes about 1.8 million barrels a day from Iran, and that will be taken from these ships that are afloat right now. And that means that the revenue received by selling at high oil prices, at low discounts, will continue at least until the end of July. For even if the blockade stays on, the blockade would have to stay until the end of July to actually start denting the finances of Iran. And if that isn't bad enough, the stupidity of these strikes, these Israeli strikes mainly, but U.S. strikes too, on oil facilities, as well as the counterattack made by the Iranians against refineries and so forth. If you add it all up, you've got about 80 refineries that have been damaged. A third of them have been damaged, but severely. And it's going to take about 2 years just to repair those facilities. So we have a 2 year right now. If nothing else happened today, we're going to be 2 years into a repair job and re-drilling oil fields in Iran and so forth before things come up to where they were prior to the war. So all these damage costs, by the way, which I don't think were probably included in that $1 trillion number, the Harvard number, but as I say, I haven't read the study, so I don't know the details, but all of these costs would have to be included in any global cost of the war, and none of these things have been included in anything the Trump administration has done, because they've been flying blind. Mm-hmm. They don't know what they're doing.
I want to touch on this. This is a study you've done, so you're well familiar with this. The world's most and least miserable economies in 2025 are ranked at number 1, Venezuela. Contributing factor inflation. Where is the United States?
Well,
this is
the U.S.
119.
Is 119. They're 119. They're not very, very good. Today, by the way, the Pope Leo's in Cameroon. Cameroon ranks 120. They're actually slightly better than the United States. This is we're speaking April 16th, but at any rate, look at number 1. You'll love the least miserable country in the world. Go down to that.
Yeah, that's Taiwan. Okay, so the main issue is unemployment.
David, your relatives, send that to your relatives immediately.
I will. I mean, this is a very interesting index, and I wonder how you've constructed this. I can tell you, the people of Taiwan, from my personal observation, they're happy. They're not making a lot of money, though. I mean, it's you compared to purchasing power. If you take the purchasing power parity of their earnings versus U.S. dollars, they're not making a lot of money. But yeah, people are happy. You're right. How do you, broadly speaking, what's in this index, and how do you measure misery?
We can do it. We can do it very precisely, because there are 4 variables in this. One is the inflation rate. That makes you miserable. So the higher the inflation, obviously, the higher the number is, and the more it adds to my Hanke's annual misery index. So unemployment is one factor, also, in addition to inflation, and I double the unemployment rate, because not having a job is makes you much more miserable than just paying a little more for groceries. So we have the inflation rate plus the unemployment rate multiplied by 2. You take those 2 numbers, you add them together, and you get add another third number, and that's the bank lending rate. How much it costs you if you go to take out credit at a bank. So that's the bank lending rate. So you add those three things together, and that makes, those are bads. Those are misery-inducing items. The thing that reduces or mitigates the misery is GDP per capita growth, which you alluded to, and you subtract that number, whatever it happens to be, from the addition of the three variables that I gave you before, and that's how you get your misery index score. So the reason Taiwan is in good shape, unemployment's pretty low, bank lending rates are low, inflation is low, and GDP per capita is growing at a pretty good rate.
Do you see the U.S. changing up or down anytime soon?
I think the U.S. continues to deteriorate, and I think it will continue to. It's been deteriorating for some time, and I think it will continue to deteriorate. Look at those top countries in there. You get some of the standard. You get Taiwan. Where's Hong Kong, David?
158. It is below the U.S., so slightly less miserable.
Yeah, right. So Singapore, all these Southeast Asia countries, all the tigers do pretty well.
Japan is at the bottom. I wonder where's Japan, Canada.
Right. Yeah.
98. Canada is more miserable than the United States. Okay.
Canada is, yeah, that's what you'd expect. You're up there in Vancouver today.
The lending rate is...
And you look a little more miserable than I do.
Sorry.
And both of us are more miserable than your relatives in Taiwan.
I like the unafford. I don't know how you would categorize this, but I can tell you firsthand, Canadians are miserable because of unaffordability. People here can't buy homes, we can't buy cars, groceries are getting more expensive. How would you make a category for that? How would you describe that here in this chart? Because here you have the lending rate as the prime cause, but I would right. Go ahead.
The lending rate's pretty critical because that to acquire credit, and I don't have the exact number for Canada now. It's higher than the United States, but that's a key thing because it comes into you want to buy a home. Well, you got to unless you'll have a lot of cash and pay cash, you've got to get a mortgage, and the mortgage will have a lending rate attached to it. So that gets into affordability. The inflation number reflects it. And also, by the way, even the unemployment does. What if you don't have a job? That's pretty bad because that means you've got to go on welfare, and that's going to ding your affordability thing. So all of four components factor into affordability because even GDP per capita, if GDP per capita is rising rapidly, your income's rising rapidly, that means that your income is less of a constraint on you buying things.
Finally, Professor, before we go, I
think by the way, since we have international people watching, I think you should link that article. It only comes out once a year, by Hanke's annual misery index, and it's widely cited, so forth, and pretty useful actually.
Let me put this Fortune article up on the screen in the description rather, and people can scroll through the entire index and see where your country sits in Hanke's misery index. Yes, like you said, Professor, it comes out every year, so good timing to talk about it this year. Before I go, I need to get your reaction to this. Two companies this week, just two that I'm aware of, have pivoted to AI, and their stock prices immediately went up by the order of triple digits in percentages. So one of them is Allbirds. Allbirds is a shoe retailer. Okay, and they announced earlier this week that they are now pivoting very abruptly to AI compute infrastructure. Previously, they were a shoe retailer. Okay, Myzium is another one. And by the way, their stock went up This is their stock. Went from $2.60 a share to $16 overnight. Myzium is another one. That is a social media company. This stock soared 100% after rebranding as Myzium AI. Where have we seen this before?
Well, what this shows you, this is what I keep telling you, and I'm using, by the way, AI. I'm a skeptic, but I use it. It's if you know what you're doing, there are all kinds of AIs. There's a whole menu of things for AI, and for different tasks, I use different AI as kind of research assistants, and it is productive for me, because I'd have to send an assistant over to the library. They'd spend a week or 10 days doing something that I can do in about an hour on AI. So but the problem in using it, you've got to know what you're doing and what you're asking, and I do know what I'm doing and what I'm asking. So it's pretty easy for me to direct, and it's pretty easy to detect errors in the thing too. Now, back to the stock price, getting off my personalized thing, which I shouldn't have done. Productivity. These two companies, this is hype. It's clearly hype. There's no way their profits are going to increase by as much as implied by those huge increases in stock prices. And the stock price, remember, the stock market's just a present valuing machine. It calculates the present value of free cash flow coming into the company. And there's no way free cash flow is surging by that amount just because of the adoption of AI. And you pick up this hype, by the way, with AI hype. Productivity in the United States was 3% per annum in 2024. In 2025, it was 2.1%. Last year, it actually went down. So all of this hype around AI and people adopting it and increasing productivity and so forth, if you aggregate, look at the economy as a whole, it's not comporting with what we're getting out of Silicon Valley hype, or what I call Silly Valley hype. By the way, I would those two stocks, if I was following through, those would be prime shorts. I think that they're primed to short, because there's just no way you're going to get that kind of improvement in valuation just because of adoption of AI. It's just not going to happen. Because the only way it could happen is to have a massive increase in free cash flow, and to justify that kind of increase in present value or stock price, I just don't. I think, this is a conjecture. This isn't based on due diligence. I haven't analyzed the companies or anything like that. But my conjecture is that it's hype, overdone. And my conjecture is that if that's true, these companies are prime candidates for shorting.
Prime candidates for shorting. We'll follow up on that. Thank you very much, Professor, for that conclusion. Where can we follow your work for now?
Follow me on X, at Steve_Hanke, or David, the usual. If people want to be on my weekly distribution, just send me an email, Hanke, Hanke, at jhu.edu. And particularly for David Lind followers, I get a lot of emails, and they're all put on the distribution list and so forth. And whatever questions they have, I try to answer them to the best of my ability. So David Lind viewers, shall we say, get not only treatment, they get special treatment.
Thank you very much for the special treatment. We appreciate it. Thank you, Professor. And we will put the links down below. So make sure to follow Professor Hanke there. Take care for now. We'll speak again soon, Professor Hanke.
And if they want to get into the weeds on monetary theory, my book, you should link my new book with Matt Sakurki, Making Money Work.
And I will say, I do like this new look for you. You may consider it even if your hand is not temporarily disabled.
Well, yeah. Well, Mrs. Hanke objects, but
Oh, okay. All right. Well, she wins. She's the boss.
David, you'll understand. Madame is French, Parisian, very old school.
Okay.
Parisians are much more old school than most people think.
They dress better as well. So I understand. Okay. Thank you very much, Professor. We'll speak next time.
Okay,
Have a good
thank you.
afternoon.